Hi everyone, this is Steve Elwell, Chief Investment Officer of Level Financial Advisors, and this is your second quarter 2019 market review. The second quarter was a little bit of a roller coaster. April was good, May was bad, and June recovered everything that was lost in May and then some. The U.S. stock market finished up approximately 4% for the quarter, along with international stocks slightly below that. Emerging market stocks and global real estate were positive for the quarter as well, although to a lesser degree. The bond market also had a good quarter, very good and above average for the bond market, mainly because there was additional information and belief that the Federal Reserve and global central banks are now considering possibly cutting interest rates to help stem any type of economic slowdown. And that is really an incredibly stark reversal from what they were talking about doing last fall in 2018. So originally they, in the first part of 2019, came to the conclusion that they really weren't going to raise rates at all and just kind of keep things where they were. And then belief mounted as we moved on through the second quarter that they actually were going to consider cutting rates. And we will find out soon. There's a lot of talk about the July meeting being the time that they'll cut rates, potentially 0.25%. So a really pretty incredible reversal there, which really takes you back to remembering how difficult it is for any expert, let alone the top economists at the Federal Reserve Board, of trying to figure out what direction the economy may go and what type of policy might be appropriate during that. You know, there's a fair amount of people that are arguing, how is it that an interest rate cut makes sense when we have the stock market near and at and breaking all-time highs? We have unemployment at near record lows. What exactly are we cutting rates for? Which is a fair argument. On the flip side of that, though, the Federal Reserve has a dual mandate, and that mandate is two things. It's to keep unemployment low, which check, that box is covered, no problem there. And then the second piece of that is to maintain stable inflation and a slight growth of inflation, usually targeting somewhere around 2%. And inflation has been pretty low, lower than what they thought it would be. And usually there's the belief that if the economy is doing really well and growing and unemployment is really low and people are finding jobs and working, that kind of generally causes inflation to heat up a little bit as wage pressure starts to apply, as companies are having difficulty finding and attracting talent. They tend to sometimes start to pay more for that talent, and that kind of ripples its way through the economy from an inflation standpoint. And it just really hasn't happened despite unemployment being so low. So if there is an argument for potentially a cut, if they are viewing danger or softness in the economy from a ongoing trade war, and if they're viewing very low inflation and saying that, listen, if we're trying to tackle that, then I guess maybe that can be their argument for cutting rates. We, of course, will see if they actually do it and if what it is that they say when they do it. So that's lingering out there, but that's been good news for bonds. As a reminder, when rates go down, when interest rates go down, bond values go up. They have an inverse relationship. So not only are the bonds that we own continuing to pay their normal interest, which is the majority of the return you get from those investments, but whenever they do fluctuate in value, the direction that they fluctuate is based on what's happening in interest rates. And interest rates have come down pretty substantially over the last 6 months, and so the value of the bonds have gone up in conjunction with continuing to pay the interest payments that they pay each quarter and each month. So a good recipe for the bond market for the first 6 months of the year, and we will see how things go as we look at the second half of the year. Beyond that, if we take a longer term view, We can see that the last year there's been some divergence. U.S. stock market's done pretty well. International and emerging market stocks have not done as well, but are positive. Global real estate's done pretty well. The bond market's done well, like I said, as interest rates have come down. And over the last 5 and 10 years, you can see that, specifically for the U.S. stock market, the last 10 years has been phenomenal and well above average. The long-term 90-plus year average of the U.S. stock market is approximately 10%. In the last 10 years, the U.S. stock market has averaged about 14.5%. Of course, remember when we're starting, when we looked 10 years ago was near the bottom of the 2008-2009 stock market crash. So when you're talking about a starting period, that's a pretty phenomenal time to start. It's easy to say with hindsight, looking backwards, that the last 10 years have been really good. Of course, I remember in March of 2009, in June of 2009, the experts were all predicting this was going to take 10 or 20 years to just recover to the highs of 2007. And that, of course, looks like an incredibly foolish prediction when you see where things are at right now. So the last 10 years have been great for the U.S. stock market. If you were able to predict that that was going to be the best asset class, you would have simply put all your money into that category. I remember, again, back in the middle of 2009, the argument was emerging market stocks were the place to be going forward because they have the highest economic growth. They have demographic growth. When you look at the population of China, the long-standing belief at that moment was if you're going to invest in any stocks, those are the stocks to own. And of course, now we look backwards and that didn't do poorly over that period, about 5.8% return annualized over those 10 years, but obviously not the best of the category. So again, if we're following what Wall Street's predictions are, as usual, they're just not particularly good. They're not really something that you can follow with great success. And those that have been investing with us for a long period of time know we are not in the prediction game. We don't really make any predictions at all, especially about the short term. And we don't need to. The stock market and the bond markets are markets that tend to work over time in the sense of we don't need to make predictions. All we simply need to do is participate. And so I want to let that marinate and sink in for a second. Think about if this was a basketball game or a soccer game, we don't need to shoot three-pointers and make them. We don't need to dunk. We don't need to score goals. We don't need to do anything other than put on the uniform and stand in the court or stand in the soccer field for however long the game lasts. And in our terms, the game is, through our careers and through our retirement time span. And all we need to do is participate. We don't need to do anything special. We will get the returns that we need to make our plans work by just simply showing up. And so when we look at time frames for how well the market does, stock market does in general over any type of period, over a 1-year period, about 75% of the time they're positive. So the vast majority of the time, if we just hold on for 12 months, things are probably going to be fine and we'll probably make money. When we look over a 5-year period, now we're talking about 87% of the time markets provided positive returns over 5 years. And if we extend that out over to a 10-year period, now we're talking approximately 95% of the time the stock market has provided positive returns over a 10-year period. Now, having said that, we had just within the last 20 years, a period where the market did not make money over 10 years. And some of you can remember that. It's starting in 1999 through 2009. If we go, the end of June 1999 through the end of June 2009, we've got S&P 500 returns of negative 2% over that period. Now let's remember what happened there. 99 was near the peak of the tech bubble. And of course, 10 years later was the bottom of the 2008 crash. So you started at a really peak stock market level, and you ended right in the middle of a crash. And so that's how you get a period where you have negative returns over 10 years. Now, having said that, here's where we circle back to diversification and how it's really the only free lunch in investing. Over that period, the international stock market actually outperformed the S&P 500 by about 5% a year. International stocks earned about 3% annually from 1999 to 2009. So that would be a great justification for saying, why do we own different asset classes? Because we cannot predict, even though the vast majority of the time the stock market's going to do well, that doesn't always mean that the U.S. stock market would do well. Sometimes that means international stocks will provide the returns. Or like the last 10 years, it'd be the other way around. The U.S. stock market provided the outsized returns, and international stocks did okay, but not nearly as well as the U.S. And that tells us nothing about the next 10 years. It doesn't mean it's going to turn tomorrow. It could. Maybe it'll turn a year from now. Maybe both will do equally well. But the point is, we don't even need to try and predict which one is going to do best. Again, all we need to do is participate. Stick with the diversified game plan, and we're going to get the returns from whichever one is the one that does best. The problem and the difficulty of diversifying is you always have a scapegoat to look at over any short-term period and say, well, I wish I didn't own that, right? So far here in 2019, the first 6 months, because the vast majority of any investment category has done pretty well, really what you would wish that you had owned none of is really short-term bonds, which haven't done poorly. But when you look at the stock markets earned, 17% for the year, and global real estate's up 20, and other categories are up 10 and 15%. Of course, you would say, man, I really wish I didn't own any short-term bonds. The other breath, if there's a big stock market crash like there was in the fourth quarter of 2018, then you say, well, thank goodness that I owned those short-term bonds, which held their value and made money and went up in value in those 3 months while the stock market was declining 20%. So the point I'm making is that you will probably always be disappointed in something, no matter what time frame you're looking at your investment portfolio. If you're truly diversified, there'll be something that you look at and say, man, I really wish I didn't own that. But it will constantly change. One year you may be disappointed in global real estate. The next year you might be disappointed in bonds. The next year you might be disappointed in large U.S. stocks. It constantly will change, and there's no point of trying to predict which one's going to do best in the short run. If you're truly diversified, that's something that you don't have to play that game. So again, if you stick with it and participate, then you're very, very likely to do well, especially the longer your time frame. So if I again go back to, let's say you started investing at the worst time of the last 20 years, back at the peak of the tech bubble in 1999, still your annualized return over 20 years from 1999 to 2019 would be around 5%. That's what the stock market has earned over that period, if you're talking about just pure stocks. And I know when we talk about the really long run returns of the stock market being around 10%, that's a below average 20-year period, but you still earned something. It's not negative. I think the thing that is also worth pointing out is the stock market doesn't necessarily owe you anything, right? So if we know that the long-term returns of stocks typically are around 10%, that means that you may get something different, and you very likely will get something different, depending on when it is that you start. And it doesn't owe you anything. You're not guaranteed to get anything. But again, the longer that you participate and the longer you stick with it, the more likely you are to get returns close to those long-term averages, of course adjusting for the amount of risk you take. So if you do not have 100% in stocks, you obviously cannot expect you're going to get 100% of the stock market's return. But we have a nice chart here from DFA that we look at that says even though the long-term return of the market may be 10%, there have only been a few years that actually had a calendar year return close to 10%. the majority of the time it's something dramatically different. Sometimes as high as 40 or 50% in any calendar year, and other times as low as 35 or 40% decline. 2008 being the most recent example of that. But when you work out the averages, that's how you start to get to the point where your stocks average somewhere near 10% over a really long-term period. So we kind of relate that question or that statement back to a question or statement that we continue to hear and have heard over the last couple of years, which is this market cannot continue to go upwards. How is it that the market keeps pushing on to new highs? Isn't it extremely overvalued and going to crash? Aren't we due for a crash? Isn't a crash right around the corner? And the reality is we don't know, and you don't know, and no one else knows whether that's going to happen, but it doesn't have to happen. If we look at the valuations of what the stock market looks like, it's compared to history, the historical average, it's slightly above average. Not dramatically above average, slightly above average. And the valuations in the stock market are, for the most part, justified. If you look at corporate earnings for the S&P 500, they're pretty high, dramatically higher than where they were 5 years ago. So you would expect that prices would be higher if companies are earning more money. So those things are that's the bottom line when it comes to investing in stocks is what are they earning, what type of profits and dividend payments are coming out to investors, and the share price is going to reflect that as millions of investors trade every second of every trading day, reflecting that new information as we get more and more information about how companies are doing, how the economy is doing. Those are all reflected in prices almost immediately. So while yes, it can kind of seem like how is it possible that the stock market can continue to go up, the reality is there's no requirement for it to go down, either in any one given year or any short-term time frame. So as we think about that, a lot of people will kind of say, well, I want to invest some more cash, but I'm going to wait for the next pullback. Well, buckle up. Who knows how long you're going to wait? You might wait a week. You might wait 10 months. You might wait 3 years. We don't know when the next pullback will come. They do typically come, a couple of times a year. There'll be a 5 or 10% pullback. That's totally normal. We got a 20% pullback, like I said, in the fourth quarter of 2018, and that was still normal. That was not wildly abnormal, not by history's measure anyways. So the best advice we can give you is the best time for you to invest is simply when you have the money. If we go back to the DFA chart that says what is the percent of time that the stock market's up over a 12-month period, approximately 75% of the time, those odds are pretty good. That's not a guarantee. It's definitely not a guarantee. But the key is not trying to time the market when the best time to put the money in is. The key is allowing your money to be invested for the longest time possible, which of course means the sooner you put it to work, the better. And that seems like shouldn't I be more conscious of where prices are currently at? But based on that statement, you're trying to make a prediction of today's potentially overvalued compared to what tomorrow may be, or next month, or next quarter, or next year. And because you don't know what's going to happen in the next year, and no one else does either, that makes you believe that your best bet is simply just to put that money to work now and give yourself as much time as possible for those dollars to compound and earn, which is the whole idea of what we're trying to do here. We're putting our money to the investment markets to try and grow it. So I really want to constantly dispel the idea that a crash must be coming, a recession must be coming, that this stock market cannot continue to go up, that we should wait for some type of pullback to invest cash. The market just simply doesn't work that way. That's not the way it works. While on average there are pullbacks and there are periods that in hindsight look really, really good to start investing. I'll circle back again to the 2008-2009 crash. If we look backwards, March of 2009 was the absolute best time to start investing in the last 10 or 15 years when we look at that. But if I had said, hey, Mr. Smith, you have a lot of cash in the bank, let's go put a bunch of it to work now that the stock market has just gone down 35% and there are predictions that the entire financial system is going to collapse, it's going to be extremely difficult for a person to get on board with that game plan because we're humans. Our human nature is we have a recency bias. Whatever has recently happened, we think is going to keep happening. And if the stock market just crashed 35%, nobody feels particularly good about buying stocks, even though in the long run, it's probably a really good idea to do that. So your best bet is simply to take all of those predictions off the table and just say, wait a minute, I know if I just stick with it and participate in the investment markets, I don't have to make predictions about when things are going to be good or bad. If I just simply participate and I stick around and stick to that game plan for long enough, I'm very, very likely to be successful. So we kind of like to just circle back to that. I try and incorporate a lot of the questions that I hear from clients and people that I talk to because it's likely that more people have those questions. If I hear the same question a couple of times, it's very likely a lot of people have that same type of question or concern. So the second quarter in recap was pretty good, a bit of a roller coaster, but pretty good. Somewhat across the board, really. So things have been going well on that front. I do also want to point out that our Hamburg office is now or will be open as of July 15th. So if that office is close to you and you'd like to meet with us there for your annual review meeting, then by all means let our staff know or your advisor know when you're ready to meet that you want to meet at the new Hamburg office. Other than that, I hope everybody enjoys the summer, and we'll talk to you in a couple of months to recap what happened in the third quarter. Take care.